Hello, people. Hello, Ilma. Hello, Yusuf. Only two people are there in the class today. Let's get down to business, shall we? So my plan is to look at just one question today. Yes. Hello, Ilma. How's it going? All good, I suppose. No, just a few more days for the exam. Yes. So must be studying very, very hard. Yes. Keep at it. It's just for the next couple of weeks. Yes. Right. Okay. Okay. Uh, so what we are going to look at is just one question today, and that question is going to be on, so I was looking at these two, and I think this is a good question. NN Company. This is a question on valuations. Now, in your FM paper, one of the major areas tested is WACC, right? Cost of capital. And then you have, investment appraisal, right? The secondary area related to WACC, cost of capital, and business financing is, well, your valuations. There are so many valuation methods. Yes, you have cash flow based valuations, you have dividend based valuations, you have multiple based valuations like PE and whatnot. You have your asset based valuation models. So many valuation models are there. Yes, so remember, when you sit for the exam, you have to have an idea of all the valuation methods, right? There is no one best valuation method. It depends on the circumstances that you're looking at, the situation that the company is in. For example, let's say you're going for a merger or acquisition. Now, that is not discussed in FM. So let's say you're planning to buy another company, then you need to understand the minimum value of that company. You need to understand the maximum value of that company. Yes. Let's say you want to sell your company, right? So you need to understand the minimum value and the maximum value. So the buyer is going to come up with a price in between the two. Yes, in an ideal scenario. So, like I said, um, there are different valuation methods. The valuation method that you use is going to differ on the situation and the circumstances, right? This is a good question uh, because it asks you to calculate the value of NN using two methods. Number one, the dividend growth and net asset value. So you have dividend models and net asset value. Net asset value is basically what? Uh, Value of assets minus value of liabilities. Yes, that's your net assets, right? And then you have after-tax cost of debt, and then WACC, and then part D is related to what? Market efficiencies. Efficient market hypothesis, right? This is a theory area, Ilma. So I know that you guys are not very fond of theory, but you can't get, you can't get rid of theory. Theory is there all the time. Okay, shall we look at this? Okay. What's the requirement? Requirement is calculate the value of equity using following business valuation methods. Number one, dividend growth. So dividend growth is D1 divided by AE minus G. Right? This is dividend growth. Yes. So sometimes you can show D1 as D0 into 1 plus G. Plus G, yes. Sorry, 1 plus G. Right. You can show your dividend growth even in this way, right? So once you find the price, then what do you do? To get the value of equity, I'll say PE is P0, right? P0 into number of shares. This is how you find the value of equity using dividend growth. Yes, DGM. I'll say DGM or dividend growth model or Gordon's growth model, anything. Right? Okay. Shall we look at the question? Right. What are we looking at? Following financial information refers to NN, current statement of financial position. So you're looking at assets, you're looking at equity and liabilities, you're looking at non-current liabilities, you're looking at current liabilities, total equity and liabilities, right? Okay, so total assets are 143. You have total liabilities. How much is your total liabilities? 49. Total assets are 143. Total liabilities are 49. So equity should be 94, right? Okay. From the outset, I don't think you can comment much. So let's straight away get down to, well, we'll read the paragraphs and let's get down to the calculation, right? Please read the three paragraphs. You know what? Please read this part, the first paragraph. Read the paragraph, guys? Did you read the paragraph? Hello, Kaif. Join just in time. Yeah. Right. Okay. So what are we looking at? So Kaif, we are looking at a question on business valuation. We just started. NN company has just paid a dividend of 66 cents per share and has a cost of equity 12%. The dividends of the company have grown in recent years by average rate of 3% per year. The ordinary shares of the company have a nominal value of 50 cents and ex-dividend market value is 8.3. Guys, now I will take this opportunity to explain a few things. So here they are paid a dividend, right? They paid a dividend. Dividend paid. So this is your dividend at time T0. T0, yes. 66 cents, right? They tell you that cost of equity is 12%, right? Cost of equity, 12%. Yeah. Dividend growth in the recent past, how much? 3%. So G is 3%. The ordinary shares of the company has a nominal value of 50 cents, right? So I'm going to say nominal value 50 cents. Cents no 0.66 and 0.5. Yeah, right. Ex dividend market value, how much? Ex dividend market value. Ex div price is 8 point something. 8.3. Okay. Guys, what is meant by ex dividend price? Why are they giving you the ex dividend price here? Why can't they say, price? Why do they have to mention ex dividend? Why is that? Why is that? Guys, according to dividend theory, right? Ex dividend price is what? Cum dividend price minus what? Current dividend, yes. Vilma? Can you remember this equation? Ex-dividend price. So ex-dividend price, remember, that is the price of the dividend, sorry, price of the stock without the dividend. Price without the dividend. Yes. Remember, in calculations, you always work with ex-dividend price, right? Always work with ex-dividend price. In exam questions, always work with ex-div price, right? Okay, nominal value is given, blah, blah, blah. Now, what do I need to do? Calculate the value of equity of company using dividend growth, right? There you go. This is my dividend growth method. I'm sorry, dividend growth model. Okay, so I know D0, right? D0 is how much? D0 is the dividend just paid, 0.66. Do I know the growth rate? Hell yes, that's 3%. Cost of equity, yes, I know that as well, 12%. Right, so I can get the price, yeah. I can get the price. So this is 0.03. D0 is, sorry, D0 is 0.66. Cost of equity is 12%, 0.12, and growth rate is 0.02. So you can get the valid dividend. Price is 7.55. So simple, 7.55. Done. There you go, 7.55. Now I can get the I can get the value of the company. Yes. There you go. Value of the company is this. Price today divided, sorry, price today into number of shares. Do I know the number of shares? People, ordinary share capital is given 50. So you know that these are recorded at, nominal values. Yes. So I know total nominal value. Total nominal value is how much? 50 million. Right. What is the nominal value per unit? That's 0.5 here. 50 cents, no? 50 cents, yes. Right. So we can say number of shares. Number of shares. 0.50 divided by 0.5, yes. 50 divided by people, that's 100. That is 100. Are we clear? 50 divided by 0.5 is the nominal value. Yeah. Yep. Yep. So therefore, what's my market value? DE is equal to 7.55 that into 100. 75.5 million is my market value. This is according to the dividend growth model. Dividend growth model. Yep. Okay. Right. Simple. 700. Yeah. Oh gosh, it's 100. No, 755 million. Sorry. 755 million. My bad. 755 million. Yes. I thought this was 10. I'm sorry. Right. Number 2. So that's done. Net asset value. Right. So now I'm going to say net asset value. Net asset value. Well, what is meant by net asset value? Net asset value is what? What is net asset value? Total assets minus what? Yeah. Total assets minus NAV is assets minus liabilities. Right? This is basically your balance sheet equation. Balance sheet equation. Yes. Evil, that's basically your value of equity now. So we'll say total assets. Right. Total assets. What are your total assets? There you go. 42. Sorry. Total assets are 143. 143. Total liabilities. Total liabilities. What are your total liabilities? 49. There you go. Total liabilities are 49. 49. What a joke, people. This is so simple. So therefore, net assets. Net asset value 94, basically your equity value, yes, 94. Oh, whoa, 94 million. They mentioned which asset based, yeah, yeah. Now, you know that there are different ways of getting the NAV, you know. So you have the replacement cost method, you have realizable, what is it, NRV method, different methods are there, yes. So here, I think what you need to use is net asset value. When they say net asset value, yeah, NAV is assets minus liabilities. This is how you get the answer. Yeah, this is how you get the answer. They mentioned which asset based method. Yeah. Uh, Obviously, you can't use replacement method or NRV because you don't know the values now. You get it? So there you go, 94. My goodness, this is the value of equity, book value of equity. But the market value of equity, look at this value, 755 million. My goodness, right? Okay, that's done. That's done, right? Yes, you need to use the information, whatever that's available to you to get the answer. Okay, right. Part A is done. Shall we do part B now? After tax cost of debt, right? After tax cost of debt. So this was part A. Yeah, part A. Now let's do part B. B. What's B? After tax cost of debt. Okay, people, can you read this paragraph, please? Right. Did you read this, guys? Yeah. So what are we looking at? Long-term borrowings of NN consist of 7% bonds. What are your long-term? Long-term borrowing 20. This consists of what? 7% bonds that are redeemable in 6 years at their nominal value 100 per bond. Current ex-interest market price of the bond is 103.5. Right. People, they tell you there is a debt, right? You have different types of debt. No, this is a redeemable debt, right? Redeemable debt. What is meant by a redeemable debt? So your debt has a expiry. When is that expiry? Debt has an expiry. When is that expiry? 6 years now. Right. T is 6 years. Right. Right. 6 years. Yeah. Ah. Very good. Yes. Very good. Yes, Silva. That's the logic. Yes. They tell you 7% bonds. So this should be the, bond, guys. You have what? You have two cash flows attached. Yes. You have the redeemable. The price at which the bond is redeemed, and then the coupon. Yes, interest. So 7% is your coupon. So I'm gonna say coupon percentage is 7%. There you go. So this is my fixed interest, no? Fixed interest per annum. You get it now. So they want me to find what is the market price. They tell me market price is 103.5. Face value. Face value is 100. Market value 103.5. Face value, nominal value, anything people. Yes, redeemable value. Yeah, there. Now, people, this is a redeemable debt, no? Right? You have to find what? After tax cost of debt. After tax cost of debt. We know after tax cost of debt is after-tax cost of debt. What they're referring to is KD1 minus T. KD1 minus T, right? This is what they're referring to. So I have to find KD is the requirement. Because this is a redeemable debt, right? You know, to find the cost of a redeemable debt, you have to use the yield to maturity or the IRR. Yes. So I'm going to say cost of redeemable debt is equal to cost of redeemable debt is equal to the yield to maturity, which is your IRR, right? So you know IRR, you know the equation. Yes. Now you will have your own way of remembering the IRR equation. So I'm not going to show the IRR equation. You know to calculate the IRR, take any two discounting factors, calculate the NPVs, and then what? Substitute the values into the IRR equation. No big deal. Yes. This is what you need to do. IRR. So I'm going to say IRR DCF low is equal plus NPV high. Now you will have your own method of own way of interpreting this. Don't get confused when I write the my equation. NPV, this is NPV L whole thing into DCF high minus DCF LDSR. This whole thing within brackets, right? This is your IRR, right? Now let's do this. Take any two discounting factors, people. Any two discounting factors. So we have to do the NPV table. So what I'm going to do is TCF, DCF, CF into DCF, right? So I have to take two discounting factors. Now take 5% and 10%. 5% DCF, 10%. Here I'll say CF into DCF. CF into DCF is my present value, right? This is my PV, right? This is my present value. Are we clear? CF into DCF is my PV. Are we clear, guys? So here, okay. Now, how many years are we looking at, people? 6 years. No, 1, 2, 3, 4, 5, 6. Right. There are different ways of getting the answer. I'm going to show you, both methods. In my mind, in my opinion, you can use two methods. Two. Right. Okay. Now, what cash flows are you going to get when you invest in a bond, guys? Yeah. What are the cash flows that you get when you invest in a bond? Yes. What are the cash flows? Yes, Ilma. You get coupon. Is your IRR? Yes. That's okay. That's what use of. The way I show IRR and the way you show IRR is different. But it gives you the same answer. This is perfectly right? But you stick to your equation. Don't use my equation, right? Yes, right. You stick to your equation. Now, please don't use my equation, right? So, people with a bond, so I'm going to say cash flows of a bond. The cash flows that you get from a bond. There are two types now. There are two cash flows. You get what? Coupon. You get coupon. And you get principal, yes. Principal. Principal is your face value or the nominal value. Sometimes they'll say your bond is redeemed at a premium. So then you have to calculate the premium as well. Usually bonds are redeemed at the face value. Coupon. How do you calculate the coupon? Coupon is coupon percentage into the face value. This is how you find the coupon. Coupon is paid annually. paid annually, sometimes semi-annually. But in your syllabus, you're looking at always annual coupons. Can we get the coupon? Can we get the coupon? So coupon, I know it's 7%. 7%. Face value, they told me face value is 100. No, there you go. Face value is 100. Ah, right. So what's my coupon? 7. There you go. This is my cost of debt. I'm borrowing money. Now I have to pay interest. There you go. Guys, don't forget, do not forget, there is taxes. There you go. So when you have taxes and when you have debt, you save some tax because of the interest payment. Yes. You save some tax because of the interest payment. So I'm going to show the net interest payment. How do I show the net interest payment? Because there is tax, right? Because there is tax, I'm gonna multiply this by 1 minus t. There you go. So coupon into face value into 1 minus t. T is, what is my tax rate? Tax rate is, oops, tax rate is 25, right? 125. How much is this? How much is this? Yeah, 25%. How much is my net coupon? Guys, now what's happening? Because of interest and tax, right? Because you have taxes, you save, right? You save some money where? You save some tax. How? Because you have interest, right? That's why we say cost of debt is cheap. See, KD 1 minus T. Yes. So now what is my net coupon? 7 into 0.07 into 100 into 0.75. 5.25. There you go. This is my coupon after adjusting for taxes. So you get 5.25. Yes, you get 5.25 every year. Every year until the bond matures. There you go. Every year until the bond matures. Then what? Then what? At maturity, in addition to the the coupon, you receive the principal as well. Yes, principal is always the face value. So I'm going to say paid at maturity. Paid at maturity. Paid at maturity. People, are we clear? Are we clear? Yep. Guys, are we clear on this? All okay? All okay? Okay. So now, so you have coupons for 6 years, and then don't forget you get the 100. You get the 100 as well. That's your cash flow at maturity. So this is 105.25. Guys, don't forget, right? You're calculating NPV. So whenever you calculate NPV, you have to have a year zero value as well. What is that year zero value? What is my year zero value? What is my year zero value? Year zero value is your price of the bond. Uh, That's how much you pay to buy the bond. Yes. And then 3.5 market value. Very good. Yes. Now view discount. We know at time t0, at any rate of discounting, it's 1. Factor is 1. Now you put the discounting factors, get the answer. 1 divided by, you can look up your discounting factors, can do it fast in that way. 1 divided by 1.05, this is 0.952. 1 divided by 1.907. 864. This is 783. 0.7783. It's 5. 1 divided by 1.05 to the power of 6. This is 0.746 divided by 1.05 to the power 4. 0.823, 0.823. Right. Now you discount, you have the discounting factor, you can get the present value. Yes, this into this. Yep, there you go. 3 decimal places, even 2 is enough. So what's my NPV? NPV, present value, there you go, minus 2.256, right? In the same way, you get the discounting factors for these 909, 826, 751, 683 divided by 1.1 to the power 5, 621, then 1 divided by 1.1 to the power 6.564. 0.564. Guys, now you know when you have the same cash flow, yes, you can, of course. Why don't you use 1 over? Yeah, that's what. Yes. Yeah, that's what I'm using. Use of, yes, 1 divided by 1 plus 10%. Yes. Yeah, that's what I'm using. Yeah. So you can get the IRR using the function. Yes, using the function in your platform. Can do that. Yes, can do that. I'll show you. Wait. 1 second. So what do you do? Multiply the cash flows. This into flow, right? So just wanted to show you the entire working. And then, right, there you go, 24. Both are minus. That's completely fine, people. You know that IRR is an approximation. Yes, you can have 2 negative NPVs, 2 positive NPVs, positive, negative. It doesn't really matter, as long as you use the correct input. Are we clear, people? Are we clear? Right, good. Now get the IRR. Now get the IRR. So plug the values in, get the IRR. Tell me the IRR. So IRR can be found using even the function, even your function, guys. Now, is that function available? Is it available? Is the IRR function available? Right. Okay. Then what you need to do is you have to have your cash flows. These are your cash flows now. These are your cash flows. Yes. So you can say plus IRR, right? Balance. And then enter. There you go. IRR is around 5%. Is it 4 point? There you go. 4.57. There you go. This is my cost of debt. No big deal. Yes. There you go. So you can plug the values into the calculator and get the answer. There you go. This is how you get the IRR. But now in the exam, no need to show, all this working. You can simply show the cash flows, right? Cash flows. That's enough and get the answer straight away. If you're going to go by, the manual calculation, that's also fine. But I don't recommend it because it's a waste of time. Right? I don't recommend it. Now, people, there's a shortcut, right? There's a shortcut to do this. What is the shortcut? What is the shortcut? What is the shortcut? But I guess this is, actually more understandable and convenient. The other method is, yes, annuity factors, exactly. When you have the same cash flow occurring for a certain number of periods, you can use annuity factor to get the present value. For example, so here I have 5.25 occurring for 6 years. Yes. So I can say present value. So let me say IRR is, what was the IRR? I can't remember. IRR 5. So 4.57. Right. This is my cost of debt, cost of redeemable, redeemable debt after tax. Done. So you can use annuity factors as well. Now, can I say using annuity factors? People, I know using annuity factors, PV of coupon, PV of coupon is coupon into annuity factors. No? Yes. So I know my coupon 5.25. Annuity factor, you look it up, right? You can look your annuity factors up from your discounting factor table, no big deal. There's my discounting factor table. One second. Actually, the AFM formula sheet, that's completely fine. We can still use this at how much was it? At we said 5%, no? 5% for 6 periods. There you go. This is the discounting rate, discount annuity factors, right? At 5% for 6 periods. There you go. 5.076. Yes. 5.076. 5.076. That's your present value of coupon. Right. So using annuity factors, I'll say at 5%. At 10%. Because, uh, what's the annuity factor at 10%? 10% annuity factor is 4.355. 4.355. 4.355. 4.355. Right. There you go. So you get the PV of the coupon 5.25 into 5.076. There you go. And then here 5.25 into 4.355. These are the present value of the coupon, right? So I get the PV of principal as well, PV of face value. Guys, that's 100 divided by 1.05 to the power 5, sorry, power 6, yes. Power 6. Wait, did I take the, we can't use IRR? Yes, that's what. You can't use IRR if you are using annuity factors. You can't. No, then it's not possible. Not possible. La? So these, actually, these are, what I'm looking at is old papers. Yes, in old papers, guys. Now, back in the day, it wasn't computerized. No? So people had to do calculations manually. No IRR, no nothing. Yeah. So this is how you calculate the answer. But I hope you understand how to get the value. Understand the method. You don't need to do it, but knowing the method is never going to harm you. Yes. So here, right. So you get the present value. Right, right. Power. there you go. This is 74. This is 1.1. 56, right? Then minus the price. Price was minus 103.5. Yes. Get the NPV. NPV is coupon plus present value minus the price. 2.2279. See, you get the same values no matter what. Yeah, same values. Yeah, even here we got 2.2 and here 79. Did we make a mistake? 100 divided by 1.6. Yeah, there you go. You end up with the same answer more or less. And then you calculate your IRR. Guys, are we clear? So you don't need to do this. Actually, using this method is much more convenient because it's easy. Easy, right? So cost of debt done. Done. Okay. Now what? Calculate after tax. Okay, that's done. Calculate weighted average after tax cost of capital. Can we do that? Right. You do it. I'll give you 5 minutes. So guys, you need to get the market values. Yes, market values. So um, I will say part C. Part C. Back. Okay. So to find the WACC, I have to use the market value equation. So let's calculate market value of equity. Market value of equity. People, right now, what is the share price? Right now, the share price is 8.3. So you can't use this. You can't use the price that we found 7.55. Right? You have to use the current market value. How much is that? 8.3. What is the number of shares you have? We found it. You have 100 million shares. So now I'm gonna say, right, market value of equity, uh, price per share 8.3, number of shares you have 100 million, and then cost of equity. Cost of equity is 12%, right? Using these, I can get the, you know what, market value of equity. Can we get it? Market value of equity is 8.3 into 100. Done. 830. Okay. So KE is also there. Right. Now let's get market value of debt. What was the price per bond? Price per bond, it was 103.5. 103.5. What is the face value? So here, guys, now don't forget they give you the value, total value of debt. How much is that? Total value of debt is, there you go, 20, right? Price of one debt instrument is, there you go, 103.5, and the nominal value is 100. So you can get the market value. Yeah. How do you get the market value? It's 103.5. Divide that by 100, and you have issued 20 million worth of debt. This is your market value. 103.5 divided by 100 into 20. Is it 20.7? I'm getting 20.7 market value of debt. Are we clear, people? And cost of debt, we found it. What was the cost of debt? Cost of debt was, where is that? 4.57. 4.57%. Done. Yep. Right. Super. Okay. Now, what do I do? Is that it? Is that it? They're talking about preference shares. No? They're talking about preference shares as well. Preference shares of NN. Now, preference shares is like irredeemable debt. Yes, irredeemable debt. You get fixed interest. Yes. How do you find the price of preference shares? Can I say P0 preference shares? How do you find the price, guys? Dividend divided by cost of debt. No? Dividend divided by cost of debt. Yes. Preference shares are hybrid financial instruments. Yes, hybrids. But in FM we say that it's a debt instrument. So you calculate the price using cost of debt, right? Uh, so D, this is my interest. Oh, I'm sorry. Can I say interest? Interest divided by cost of debt. Okay. What are we looking at? Shares are equity instruments. So you need to understand, like I said before, preference shares are hybrids. They have both features of debt and equity. Okay. Nominal value 50. Annual dividend 8. Right. Nominal value 50 cents. Dividend. So that's your interest, no? Interest, yes. Let's say dividend, because they say dividend, right? Dividend. Then how much is it? Dividend is 8%, right? So can we get the dividend? Preference share dividend. That's 0.5 into 8%, yes. 0.5 into 0.08. 0.04 is my dividend, right? Ex-dividend market, ex-dividend, what do they say? Ex-dividend value of preference shares is 67 per share. Ex-dividend value is, that is the market value. Ex-dividend value. Can I show that here? Dividend value is how much? 67 cents. 0.67, right? People, so we know the preference share dividend, right? 8% is my, cost of preference shares. Now I need to get the market value. No? Okay, what is the number of preference shares? Number of preference shares, what is that? Actually, this dividend calculation is not required. You don't need to calculate that. That's okay. I've calculated it. Preference shares, what are we looking at? There you go. Preference share capital is 25. Nominal value is 50 cents, right? Number of preference shares, 25 divided by 0.5. 25 divided by 0.5. Nominal value per unit. Total nominal value. Total nominal value is 25. So I will get the number of shares here. Number of shares are 25 divided by 0.5, 50. 50. Right. Okay. Ex-dividend value is also given. Now you have the ex-dividend value. You have the ex-dividend value, yes. Now I will say market value of equity, market value of debt, preference shares. What is the preference share price is? Price per share. How many? Price per share is, yeah, 0.67. Price per share is 0.67. And the number of shares, 50. Number of shares, 50. And then, oops, 50 million. What is the cost? Cost is KD 8%. Now I have all the information to get the WACC. No, guys, I have all the information to get the WACC. Yes. Anyone who did not understand the preference share working, let me show you preference shares. Can someone get me this value P? Can someone get me the WACC? Ilma, are we okay? Get me the WACC, will you? Yeah, get me the WACC. Get me the WACC. Okay. So Ilma, that's simply 8%. No, that should be 8%. Shouldn't it? Should be 8%, right? How much is it? 0.04 divided by a market value. No, yes, 0.04 is my dividend divided by market price is 0.67. Wait, 0.04 divided by 0.6. No, yeah. Of course, yes. Now, guys, now here your dividend percentage is 8%, right? Dividend percentage is 8%. So there you go. This is how you find the market value of the preference share. So market value is given 0.67. Yes, Ilma. I think I missed this. Dividend is 0.04. Dividend is 0.04. Cost of preference shares, you can find it using this, yes, 0.67 into 0.04, that is KD. Yeah, Ilma, thanks. I think I missed this. Yes. KD is equal to 0.67 into 0.04. What? Is it 2.68? Huh? Hmm? 1 second, 33, 6%. Yeah, I think I made a mistake. 0.04. Wait. Oh, yeah, no. Oh, Ilma, yes, I made another mistake. Yes, yes. Thank you. Thank you. Yes. KD multiply both sides both sides by KD and 0.04. I took it the other way around, yeah. Divided by 0.67. 0.59. Yep. People, they're telling you um, dividend percentage is 8%, right? So preference share dividends are always calculated on the nominal value. Nominal value is 0.5, right? So therefore dividend is this much. But we know price is dividend divided by cost of debt. Yeah. So price, preference shares, yes. So you can use this equation to get the answer. KD, KE, guys, now in FM, I think. Ilma, in FM, preference shares are considered hybrids, yes. And you divide this by KD. What do you, KD or KE? Same thing. KD or KE? It's KD, you know. We have KP, yeah, KP. Cost of preference shares, yes. Right. Okay. Let me put it as KP then, right? But KP, yeah. But it's basically debt, right? That's why I put KD, right? KP, cool. So KP is 0.06. Are we clear? Now put the values here, 0.06, 6%. Can we get the value now? Now you can get the WACC, no? Now you can get the WACC, yeah. WACC is equal to, give me the WACC. Give me the WACC. Give me the WACC. WACC is 11.56. People, now when you show the WACC equation, so what's your total capital? Total capital is 830. That's your equity. Debt is 20.7 plus value of preference shares. You get that as well. Market value preference shares. 0.67 into 50. That's 33.5 here. Right. And then you divide this by, you divide this by the value of equity. How much? 830. 830. This into 12% plus. Right. Market value of debt. That's 20.7. People, when you multiply this, right? Do you do this 4.57? Obviously, you multiply this by 4.57, but there is tax as well. Do you put 1 minus TC? If you do this, people, you're double counting. Yes, tax effect has already been accounted for in this 4.57. So you don't put you know, KD into 1 minus T there. Are we clear? Here, value of preference shares are 33.5 and the cost of debt is 0.06. Done. Are we clear? Is everyone clear with the calculation? Yes. Is everyone clear? If Yusuf, Ilma, Amra, all clear with the calculation? Valuations, are we okay? Hmm? All clear. Right. Okay. Good. 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 Brilliant. 6 marks. Okay. Last part. Explain the concept of market efficiency and distinguish between strong form and semi-strong form. Do we adjust? Ah, no. Okay. Good question. Kaif, you don't adjust. Uh, you don't adjust. Taxes. You don't have 1 minus t with preferentials. Why? Because preferentials generate a dividend, right? It generates a dividend at the end of the day. You call it a dividend, even though you get the same dividend every year. So it's like interest, but we never call it interest, right? So you have that tax adjustment 1 minus t only with debt, huh? Only with debt. Preference shares are a type of debt instrument, but then again, see, even in your balance sheet, see, preference shares are not categorized under liabilities. They're categorized under equity. So you don't have 1 minus t there. Are we clear? Are we clear? If it's an irredeemable debt, yes. If it's an irredeemable debt, yes, you have 1 minus t. Okay? Right. Super. Now people, market efficiency. Guys, now you can parrot this and come up with an answer. Market efficiency, it's a theory, right? It talks about, the power of information, basically. Power of information, yes. Right. I'm going to explain D, you know, with a simple example, right? Market efficiency, it's boring. It's theory. It's a long piece of theory, people, right? It's a very, very long piece of theory. And in any finance subject, wherever you go, EMH is there. EMH. EMH tells you, right? Stock prices fully reflect all information pertaining to it. Fully reflect all information, right? When markets are informationally efficient, no one can make excess profits. No one can make excess profits. Right. Now, if investors can make excess returns, that means there is informational inefficiencies, right? I will take an example. I'll explain this with an example. Let's say we have Hive. I'll take Hive and Ilma. Right. So Hive is an informed investor. Informed. Okay, hold on. Yeah, informed investor. Who's an informed investor, Kai? An informed investor is someone who knows what's happening in the market. Ilma, uninformed. Uninformed. Ilma doesn't know, but she's still an investor in the stock market. Guys, let's say you gets to know that a certain stock is underpriced. What is meant by underpriced, guys? Underpriced. So true price. Now using CAPM and all that, you find returns. No, they are true returns. Yes, using true returns, you can calculate the true price. Let's say true price is 500. Market price is only 300. So there you go. So Kaif gets to know that a certain stock is underpriced. There you go. So when you get to know this Kaif, what would you do? What would you do? What are you going to do about this? Hmm? Anyone? Anyone? Please answer. What are you going to do? You're going to Oh my goodness. Yes. Sorry. Ilma, hope you can hear me. I'm sorry, I've clicked on my mute button. So you get to know. So I'm talking about, I want to explain in market efficiency, but I will explain that with an inefficiency. Then you'll understand. So there are two investors in the market, Kaif and Ilma. Kaif is an informed investor, right? He knows what's happening in the market, right? He has an idea. Ilma, she doesn't have a clear idea, right? So Hive does an analysis and and identifies, let's say, a certain stock is undervalued. So what is he going to do? He's going to buy the stock now. Why? Because he can sell it at a higher price. You know Warren Buffett is. Warren Buffett's strategy is this, right? He invests a lot in undervalued companies, right? And then he cashes out later. Like, he can wait. He's willing to wait for years to cash out his investment. Are we clear? Now, do you see that in this market, only Kaif gets to know, through his analysis that this stock is undervalued. So therefore, Kaif can make profits. See? Therefore, Kaif can make profits. What about Ilma? What about Ilma? Ilma doesn't know. She's, she's buying and selling stocks in the same market as Kaif, but Ilma doesn't know this, right? Only Kaif knows this, right? So Kaif is making a profit. There you go. People, do you see that there is an information asymmetry here? Kaif knows things, Ilma doesn't. So because Kaif knows things, Kaif is making a profit. Uh, when it's like this, we say market is informationally inefficient, right? So we say, therefore, let's say only Kaif is making profits, not Ilma. Therefore, market is informationally inefficient. So if it was efficient, then Ilma would also know, that the stock is undervalued. Ilma would also know. Both of you will know, that the true price is 500. When both of you know the same information, we say the market is what? We say the market is informationally efficient. So when what Kaif knows is the same as what Ilma knows, right? So you're looking at a fair trade, yes. It's a fair economy, fair, it's there is information symmetry. Everyone knows the exact same thing. When everyone knows the exact same thing, the ability to make profits go down, people. Does that make sense? Are we clear? Right. So this is my informational inefficiency. So information efficiency, let's say, thus information efficiency is when Kaif and Ilma knows the exact same thing about the stock. When this is the case, ability to make profits decrease. Are we clear? So it was Maurice Kendall who came up with this efficient market hypothesis, guys. He said there are 3 degrees to your informational efficiency. Yes, 3 degrees. What are the 3 degrees of informational efficiency? 3 degrees of informational efficiency. Yes, weak, semi, and strong. Weak, semi, and strong. Exactly, yes. 3 degrees. There are 3 degrees at which capital market is equity markets. Yeah, equity market is efficient. weak form, weak form, semi-strong form, and strong form. People, weak form. So you're looking at how information rich the market is. Keep it, keep, what, remember it like that, how information rich the market is. When the market is weakly efficient, right, only past information is available. Past information is available. Past information is available. When the market is semi-strongly efficient, then you have past information plus publicly available information. Information with regards to what? Obviously stocks, not information about all these other nonsense. Information about stocks. Strong form, people, this cannot exist in reality. Past information plus public. You can say, if this is too confusing, people, you know what, can I make this easy? Current information. Current information. So past information, current information, and what else you have? There's something else that is available in strong form efficiency. What is that information? Yes, anyone? Very good. Insider or private information. Private information. People, private information you have to understand is held only by company insiders. Yes. Held only by company insiders. So it can't be available to everyone. Do you understand that? Held only by company insiders. Therefore, realistically, this information cannot be available to investors. Right? Yes. People, what is meant by past information? Guys, past information related to stocks is mainly what? Is mainly published information. Yeah, exactly. When we say past information, Ilma, we are looking at only published information. So that information is about what? Past stock prices, and past stock quantities, past stock volumes traded. There. So when you say weak form is where we say only past information is available. Information what related to stocks are. Please don't forget that. Past information related to stocks are available. So what do you mean by past information? Mainly past stock prices and past stock volumes. Are we clear? Semi-strong. So in semi-strong, you have past information. So you have these two again. You have what? Past stock prices and past stock volumes. When you say current information, Ilma, what are current information? What's that? What do you mean by current information here? Current information. Current information is basically, yes, let's see. Very good, yes. Like whatever that's happening, with the company right now. Yeah. Public knowledge is what you're looking at. I'll say public knowledge. Public knowledge about the company, its projects that they are undertaking, that they undertaking. You can even say announcements, right? Announcements, dividend announcements, dividend payments, whatever. There you go. Ilma, in FM, do you talk about fundamental analysis? Fundamental analysis? Do you talk about fundamental analysis and technical analysis in weak form and semi-strong? Ilma, let's see whether you can remember fundamental. All right. Okay, brilliant. So guys, there you go. These are the information that when you say current information, there you go. This is what is meant by current information. Private information, no. People, now you're asked to talk about what? You're asked to talk about concept of market efficiency. No. So what is the concept of market efficiency? Concept of market efficiency is this. Stock prices. So you take a price, guys. Yeah, you take, let's say, $100 is the price of the stock. This $100 reflect all information relating to the stock. So when you say all information, my goodness, man, you're looking at so many different types of information. Those information are your past information, current information, and private information. That's it. It's a theory. When you take a price, I don't know, any price in the market, people. Let me take, I don't know, let me show you. Okay, Coca-Cola. It's explaining something related to Coca-Cola today. What's the share price right now? Coca-Cola. Share price right now. Coca-Cola, there you go, 69.72, no people. 69.72, right? 69.72. So we say that this 69.72 reflect all information relating to Coca-Cola. What are those information? Past, current, private. So when all information is reflected, when all information is communicated, meaning investors know everything that's there about Coca-Cola. Investors know everything, right? So when this is the case, when markets are information deficient, then no one can make profits. People, one of the reasons why people trade in stock markets is because there is no efficiency. If it was efficient, then everyone would know everything that's happening. Prices wouldn't go up and down. People would act like robots. Do you get it? You see share prices going up and down, right? That's because of imperfections only. Some people are buying, some people are selling, some people know what's happening, some people do not know jack shit. You get it? So one of the reasons why markets operate is because there is no efficiency. So when markets are efficient, then no one is going to trade. So therefore, no one is going to make excess profits. People can make profits. In economics, you talk about normal profits. Yes, normal profits. Yes, those you can generate. But excess profits, no chance. For you to make excess profits, then there has to be situations like this. There is an investor who knows, and there is another investor who doesn't know. So the people who know, they make profits. You know what happens in reality, people? Ilma, so in the market, there are two types of investors, yeah, informed and uninformed. Uninformed investors, they copy informed investors, they mimic. When Kaif buy shares of this stock, Ilma is also going to buy because Ilma is an uninformed investor. She is willing to do anything that other people do in the market, right? She copies other people. Avik makes irrational decisions. Yes, very good, very good. Are we clear, people? Are we clear? So you come up with a basic explanation. You don't have to now. I see a lot of students, memorizing market efficiency. It's a huge toll on your memory, people. Right? You create space. How? Understand the logic. Understand the logic. You come up with an example like this. Examiner will be very very impressed. Right? There's an investor. Actually, you don't need to. You don't need to, but this is how you remember using a practical scenario. Are we clear? So you talk about strong form, semi-strong form. Semi-strong form is where you have past and current information. People, we say most of the developed capital markets, most of the developed capital markets, most of the developed capital markets are semi-strongly efficient. Are semi-strongly efficient, right? Strong form efficiency cannot exist in practice. Why? In practice. Why is that? Why? Because you have private information. Private information. Private information is held only by insiders. Are we clear? Are we clear, people? A brief answer is more than enough, people. More than enough. Are we clear? Are we clear? Good, good, brilliant. Any questions, people? Any questions before we wind up? So that's it. 1.5 hours. We have looked at a solid question on valuation. So next week, guys, I'm planning to look at a question on investment appraisal. Now, so you know that your lecturers, wherever you're studying, I'm sure you guys are studying at PPIM. So I'm sure Salman sir may have looked at like different areas. Identify the areas which you're not very comfortable with, right? Which you're not very comfortable with. Okay, good. And then attempt a question or two, right? When you get stuck, look at the answer. That's completely fine, right? That is completely fine. A subject like FM, guys, can get through with a good mark actually, but depends on your effort. Get it? So there are other areas, yes, working capital management. Now I've looked at two questions on cost of capital and then one question on business valuations. Maybe look at another question on business valuations. Focus more on investment appraisal. Yes, right. Cost of capital and all that are frequently tested. Rights issues, all these things. Yeah, I think we looked at like most of these concepts. You know, during our last couple of revision classes. Right. Anyway, people. So with that, I want to wrap things up for today. Hope got something. Hope you learned something from this session. Right. The reason why I wanted to look at this question was to give you an idea of valuations. Valuations not very difficult, people, but there are so many methods. Maybe look at another question where you have different valuation models. Right. People, are we clear? Are we clear, guys? Do you have any questions before we wind up? Any questions? Any questions? All good? Yusuf, all good? Amra, all good? All good? Very good, very good. Keep practicing, people. Keep practicing. Can you please send? Oh my goodness, yes, yes. You know what, Kaiv? I'm going to share this as well as my previous Excel sheet right now. I'm very sorry, okay? I'll share it right now. All right. Okay, guys. Yeah, we'll stop with that. Then I'll see you guys next week. Let's see whether we can do at least a couple of questions. Thank you so much for joining, guys. Good night. Keep studying. You're very welcome. Keep studying. Don't give up. Yeah, just a few more days. Yeah, don't give up. Keep at it. Okay. All right, people. Thank you. Good night. I'll see you next week.